and its analysis. Basically, it consists of two parts. As we already understood that a funds flow equation is any transaction which affects one side current assets and liabilities, other side non-current assets and liabilities. In other words, a transaction which affects one side working capital, other side what we call fixed assets and long-term securities. So that the funds flow transaction process steps are also two parts. One is statement of changes in working capital or working capital changes. And the other part is deals with non-current assets and liabilities. So, it's simply statement of changes in working capital is so prepared by applying using the current assets and liabilities of the given data. The second part deals three steps. One is statement of changes in non-current liabilities and accounts identification, profit or loss made during the year, or source from operation. The third one is sources and applications accounts given, for which one has to take all the non-current assets and liabilities accounts. So, what are the items normally be occurred in our way? Or the first one is asset side, fixed assets. See, there are three changes we can come across. One is fixed asset decrease. Without any information, a decrease in fixed asset is always a fixed depreciation. It is depreciation. Then, if a fixed asset is decreased, even though the depreciation is given, it is sale. Then, an increase in fixed asset, whether depreciation is given or not, whether depreciation is considered or not, it should be considered as a purchase. Then, investment, long-term investments, mostly are considered a non-current asset. If any increase in long-term investments, it is purchased, whereas any decrease in non-current long-term investments, it is sold for cash. Then, the leftover item under non-current asset is fictitious intangible assets. There, one has to identify increase or decrease only. Then, on the liability side, reserves and provisions. There also, increase or decrease is to be identified. Next one is share capital or debt. It may be equity share capital or debt, debenture or long-term loans. In those four accounts, if any increase is there, issued for cash, cash is received, fund is incoming, and if any decline is there, cash is paid, nothing but outflow of funds. Then, apart from all these, there are two accounts which are come in our way, or tax provision account, another is proposed dividend account. These two are can be considered either current liability or non-current liability. Unless specified, one approach is always those two items are non-current assets and liabilities accounts. Their treatment is to be discussed later. In this manner, all non-current assets and liabilities accounts must be observed and identify the such changes and to go for further. Let us study the two other accounts which are come in our way. One is tax provision account and proposed dividend account. Those two are given in our data in the form of balance sheet of 2 years. Let us see how the treatment is to be made. If the tax provision account is given, there are 2 year balance sheets. The balances are given. That is, opening balance of the particular year, nothing but previous year ending balance, and current year balance is nothing but current year balance, ending balances. If 2 balances along with this, either tax paid is given in the data or sometimes tax provision is made. In practice, a tax provision account is maintained. Every year certain amount of profit is kept apportioned for payment of tax. Therefrom tax is paid. Whatever the tax provision is made every year will be charged to the profit and loss account, considered as an expenditure. It's a provision. While coming to the tax paid is an application of fund. So if such is the case, the treatment of the tax provision account, in addition to the balances of beginning in the year at the end, either tax provision made or tax paid is given. The treatment is, if tax provision is made, by balance in tax provision account in the balance beginning of the year, nothing but previous year ending balance, and adding provision made, finding the difference with the current year balance, there will be deficit. That amount is considered as a tax paid. It is a tax paid. In case the tax paid along with the 2 years balances of the tax provision account is given, then from opening balance in the beginning, tax payment is to be deducted and the closing balance is to be compared. Definitely there will be an increase. Such increase is provision made. In simple to say, the tax provision account balances of the 2 years and either tax provision made or tax paid is given. If tax provision is made, the resultant is tax paid. If tax paid is given, the resultant is provision made. Provision made is always charged to P&L account, debitable to P&L account. It is to be considered in the next step for estimation of the profit or source from operation. And tax paid is always an application. In this manner, the tax provision account is to be estimated. While coming to the second one, proposed dividend account. Here, there is a simple practice technique one has to follow, that is, no need to prepare account for this. And then, if previous year amount is given directly considered as a payment made, it is an application of fund, and current year amount is always charged to profit and loss account. In spite of the proposed dividend balances, an interim dividend paid and declared and paid may also be given as an additional information that is to be treated separately. It should be treated one time as a charge to the profit and loss account. Another one is what we call as an application. Both should be proposed dividend and interim dividend is to be treated separately. Having understood this part, let us go for the second current assets. Changes in non-current assets and liabilities through business operations also. Certain sources may enter into the business, some amount of funds may gone outside. Here the sources are incoming funds, applications are outgoing funds. Let us see how it is to be treated. For this preparation, the profit and loss account, which is given in the balance sheets, two balances are taken. Here, we start with closing balance of the profit and loss account, that means current year balance. Then, by add certain items. These items are nothing but are debitable to the profit and loss account in general. Those are depreciation in fixed asset, loss on sale of fixed asset, decrease in fixed assets, fixed uses intangible assets, or increase in current general reserves, any reserves. or provisions. Likewise, the tax provision made during the year and the interim dividend declared and paid. Normally it is given as an adjustment or additional information, and a proposed dividend which is of what we call the current year. In this manner, all the debitable items of the normally shown on P&L account are all recorded as an add items. These items are all identified in the previous section. It may be in the form of depreciation or loss on sale of a fixed asset or the decrease in fixtures, intangible assets, or increase in reserves and provisions, and so on. Only the item is interim dividend, which is not treated in our first section. Right? Then, adding the items to the closing balance or the current year balance of the profit and loss account, we have to deduct certain items from it. Those are the opposite items or changes of these items mentioned under addition. That is, profit on sale of a fixed asset, increase in fixed asset, decrease in reserves and provisions, or what we call increase in fixtures, intangible assets, decrease in reserves and provisions, and along with the opening balance of the profit and loss account. Then the result is source from or application from operation. In case this total sum is higher than this, you will get the source from operation, real profit made during the year. Otherwise, it is loss from operation or application from operation. So, this statement can also be made in the form of an account tabular form known as profit and loss adjustment account. Again, the first step is dealt with non-current assets and liabilities accounts, where we identify either source, incoming fund, or application, outgoing fund, increase or decrease, loss on sale, profit on sale. In this manner, the such items changes are identified. By taking certain items, profit and loss account adjustment is prepared, or the statement of sources and application. Then with the help of the profit and loss account, closing balance, by adding certain items, by deducting certain items, one could arrive either source from application or from operation. The last step in fund flow statement is preparation of fund flow statement, also known as sources and applications. This statement is so prepared from the results from the previous sections. In the previous sections of Part A, where non-current assets and liabilities accounts are prepared to identify the changes, where you will have an identification of non-current assets may result either incoming fund or outgoing of fund. All incoming funds are sources, all outgoing funds are application. Besides that, profit made during the year or source from operation is so prepared with the help of profit and loss account accounts, adjustment account. There you will have a source from operation or application from operation. Say, if source from operation is arrived, it is source. Besides that, issue of shares and debt, which is identified in accounts preparation, non-current assets accounts preparation, under the second step, and then sale of fixed asset, it is also an incoming of fund. Through these sources, through sources from operation, through issue of shares and debentures, or through fixed asset sale, certain amount of funds may enter into the business, come into the business, are all sources. Then application. It is nothing but outflow of funds. Application of operations is a resultant from the immediate step called profit or loss made during the year, or source or application from operation. Then purchase of fixed asset and then redemption of preference capital and debt, tax payment made during the year, proposed dividend of the previous year is paid, it is an application, interim dividend paid given as an information, these are all the applications through which amount of cash will gone outside. So those are all called applications. The sum of the total, sum of the sources and applications, the difference is either net increase or net decrease in working capital. So in this manner, all the accounts are so considered while in preparation of funds flow statement. And it is to say that the funds flow statement analysis is a self-explanatory. Whatever as already discussed, there is equation of funds flow. Working capital changes are all equivalent to non-current assets and liabilities accounts. So whatever the source or net increase or decrease in working capital arrived here will be equals to first statement result, that is statement of changes in working capital, which is prepared with the help of current assets and liabilities accounts. In this manner, the funds flow statement is to be prepared under 4 steps. One is working capital, statement of changes in working capital. Second one, statement of identification of changes in all non-current assets and liabilities accounts. And then third one is statement of sources and application from operation. And the last one is sources and applications. And in this manner, funds flow is prepared. For further details, visit my blog. Thank you.